Most retirees with $1 million saved, sometimes $2 million, will never see $9,500 land in their account every single month. Not because the money isn't there, because nobody ever showed them how to turn a pile of accounts into an actual paycheck. Here's what I want to show you today. 4 accounts, used the right way, in the right order, for the right reasons. Social Security, a traditional IRA or 401k, a taxable brokerage account, and a Roth. By the end of this video, you'll understand exactly how those 4 pieces combine to produce $9,500 a month, reliably, predictably, and in a way that survives a bad market, a long life, and even the loss of a spouse. And here's the stakes. If you get this wrong, if you just sit on a big balance and hope it figures itself out, you end up in one of 2 places. Either you underspend out of fear, working another 5 years you didn't need to work, or you withdraw the wrong way from the wrong account at the wrong time, and you quietly shrink your own future income without ever realizing it happened. So let's start with the gap that almost nobody talks about. Because before we get to the 4 accounts, we need to talk about why having the money was never the hard part. Here's the thing about retirement savings. The financial industry has spent 40 years getting really, really good at one job, helping you accumulate, contribute to your 401k, max out your IRA, diversify, rebalance, stay the course. And for most people, it works. The balance grows. But accumulation and income are 2 completely different problems. One is about growing a number. The other is about turning that number into a paycheck that shows up every month for the next 25 or 30 years, through good markets and bad, through your healthy years and the years when medical costs eat into everything. Imagine you're 63, you've got $1.6 million across your accounts, and you're about to retire. On paper, that's a great outcome. Most people would call that a win. But if I asked you right now, where does next month's $9,500 actually come from? Which account? In what order? Taxed how? Most retirees can't answer that question, not because they're careless, because nobody ever built them an income architecture. They built a balance. This is the income architecture gap. You can have plenty of money and still not have an income plan, and those are not the same thing. Keep in mind, this isn't a small oversight. This is the difference between retiring with confidence and retiring with a number you're afraid to touch. Because when there's no architecture, no system that tells you which account funds which year and why, every withdrawal feels like a guess. And when withdrawals feel like guesses, people get conservative. They underspend. They sit on money they worked 30 years to build because spending it feels like pulling a brick out of a wall and hoping the wall doesn't fall down. So the real first step isn't picking an investment. It's designing the architecture, the system that decides where your $9,500 a month actually comes from, account by account, year by year. And that starts with getting really honest about what $9,500 is actually supposed to replace, which, as it turns out, is where most people get the whole plan wrong from the very beginning. There's a number that gets thrown around constantly in retirement planning. Replace 70 to 80% of your pre-retirement income, and on the surface, that sounds reasonable. It's specific, it's quotable, it gives you something to aim for. Here's the problem. Your income and your spending were never the same thing. Think about what comes out of a working paycheck that simply disappears the day you retire. Payroll taxes, 401k contributions, often a chunk going toward a mortgage that gets paid off around the same time. Commuting costs, work clothes, the lunches you bought because you didn't have time to make one. For a lot of people, when you actually add up what's no longer happening, the real number isn't 70 to 80% of income. It's closer to 55 to 65%, sometimes even less. So if someone was earning $180,000 a year and aims to replace 75% of that, they're targeting roughly $135,000 a year, or about $11,250 a month. But if their actual spending, the real cost of the life they're living, is closer to $9,500 a month, they've just built a plan around a number that's $1,750 a month too high. That's not a small gap. Over 25 years, that's an enormous amount of unnecessary pressure on the portfolio. This is the income replacement trap. You end up designing a retirement around a percentage of a number that no longer applies to your life, instead of designing it around what you actually spend. And here's the key. $9,500 a month isn't a marketing number. It's not a round figure I picked because it sounds nice. It's a realistic target for a lot of households once you strip out the costs that retirement removes. And it's specific enough that we can actually build a structure around it. So once you know your real number, the spending number, not the income replacement number, the next question becomes, where does the first chunk of that $9,500 come from? And for almost everyone, the answer starts in the same place, Social Security. Social Security is the foundation of this entire structure, and here's why. It's the only piece of your $9,500 that doesn't depend on the market, doesn't run out, and adjusts for inflation every single year. Everything else in this plan, the IRA, the brokerage account, the Roth, is market dependent. Social Security is not. This brings us to something I call the income floor ratio. It's simply the percentage of your $9,500 a month that comes from guaranteed sources versus the percentage that depends on how your portfolio performs. Let's say a married couple, both age 65, qualifies for a combined $3,800 a month in Social Security. That's roughly 40% of our $9,500 target. The remaining $5,700, about 60%, has to come from the portfolio. The higher that floor percentage, the more resilient the whole plan is, because a bad year in the market doesn't touch 40% of your income at all. It just sits there, arriving every month, inflation adjusted, regardless of what's happening anywhere else. Now, here's where it gets uncomfortable, and it's something almost nobody plans for: the survivor income shock. When one spouse passes away, household income from Social Security doesn't drop by half. The surviving spouse keeps the higher of the two benefits and loses the smaller one entirely. So if that $3,800 combined benefit was made up of, say, $2,200 and $1,600, the survivor doesn't keep $1,900. They keep $2,200, and the other $1,600 simply disappears. But here's the part that catches people off guard. Household expenses don't drop anywhere close to that fast. The mortgage, if there is one, doesn't change. Property taxes don't change. Utilities barely change. One person doesn't eat half as much or need half the health care. Income falls by roughly $1,600 a month, but expenses might only fall by a few hundred. That gap has to come from somewhere. And if it's not planned for, it comes out of the portfolio, often at the worst possible time, when one spouse is also grieving and not in a position to make complicated financial decisions. This is exactly why the income floor matters so much, and why claiming strategy deserves real thought. Because that decision doesn't just affect income while both spouses are alive, it determines how steep that survivor income cliff is going to be. So Social Security gives us our floor. But the floor is only 40% of the target. The other 60%, the bulk of $9,500, has to come from the accounts. And the first one we need to talk about is the one most people think of as their retirement account, the traditional IRA or 401k. Your traditional IRA or 401k is the workhorse of this entire plan. It's almost certainly your largest balance, and it's built to generate consistent, recurring withdrawals, which makes it the natural engine for the bulk of that remaining $5,700 a month. But here's the thing almost nobody wants to hear, and it's something I call the tax-deferred illusion, that account balance you see on your statement isn't entirely yours. Every dollar in a traditional IRA or 401k has an invisible partner, the IRS. You got a tax deduction going in, which means taxes are owed coming out. So when you look at a $900,000 IRA balance and think that's $900,000 of spendable money, you're overstating what's actually available to you. Depending on your tax bracket, a meaningful slice of that number, sometimes 15%, sometimes 25% or more, already belongs to someone else. It's just sitting there, deferred, not gone. This matters enormously for our $9,500 target, because it means the withdrawal rate from this account has to account for taxes on the way out, not just the dollar amount you want to land in your checking account. So, if you found this useful so far, here's something worth doing right now before we go further. Pull up your most recent IRA or 401k statement and write down the balance next to your most recent tax return. Just sit those two numbers side by side. Most people have genuinely never done that, and it's the fastest way to see how much of your number is actually shared with the IRS. Anyway, back to the engine itself. For a household drawing meaningfully from a traditional IRA, a withdrawal rate in the 4 to 5% range on that portion of the portfolio is generally considered sustainable across a 25 to 30-year retirement based on the research Bengen and later Kitches have done on safe withdrawal rates. On a $900,000 balance, that's roughly $3,000 to $3,750 a month before tax. That's a meaningful chunk of our $5,700. But notice I said before tax. After accounting for federal and possibly state income tax on that withdrawal, the after-tax number that actually lands in the bank is smaller, which is exactly why this account can't be the only source for the rest of our target. It needs a partner, one that's far more flexible and far less predictable in a good way, the taxable brokerage account. The taxable brokerage account is the most misunderstood piece of this whole structure because most people think of it as extra money, savings on top of the real retirement accounts. In this framework, it plays a specific and critical role. It's the shock absorber. Here's the tension. The first 5 to 10 years of retirement are the most dangerous years for your portfolio, not because the market is necessarily worse during that period, but because of something called sequence of returns risk. If a significant market downturn happens early, say in years 1 through 3 of retirement, and you're forced to sell shares from your IRA at depressed prices to generate income, you lock in those losses permanently. The portfolio never fully recovers, even when the market eventually does, because you've already pulled money out at the bottom. This is where the sequence buffer rule comes in. The idea is straightforward. Hold 1 to 3 years of spending needs, or in our case, roughly $68,000 to $200,000, in the brokerage account, in a mix of cash and short-term bonds, completely separate from the growth portion of your portfolio. When the market is doing fine, this buffer just sits there quietly. But in a year when the market drops sharply, instead of selling IRA shares at a loss to cover that month's $9,500, you draw from this buffer instead. The IRA stays untouched. It gets the chance to recover, and your income, your actual $9,500, never skips a beat, never gets cut, and never has to be funded by selling something at exactly the wrong moment. This is the resilience piece of the plan. It's not just math, it's risk, it's timing, and it's the difference between a portfolio that can absorb a bad few years and one that gets permanently damaged by them. The brokerage account also gives us something else, control over our tax picture, because gains here are taxed at capital gains rates, not ordinary income rates. And that flexibility becomes even more powerful when we bring in the final piece, the account that exists specifically to give you options when you need them most, the Roth. If the IRA is the engine and the brokerage account is the shock absorber, the Roth is the pressure relief valve. And I want to be really clear about something here, because most people talk about Roth accounts purely in terms of taxes. It grows tax-free, withdrawals are tax-free. That's true, but it's not actually the most valuable thing about it. The real value of a Roth IRA in retirement is freedom. I call this the Roth flexibility premium. Here's what that means in practice. Withdrawals from a Roth don't count as taxable income, and they don't affect things like how much of your Social Security gets taxed, or whether you cross into a higher Medicare premium bracket, something called IRMAA. So in any year where pulling more money from your IRA would push you into a higher tax bracket or trigger higher Medicare premiums or simply feel uncomfortable, you have a release valve. You can pull from the Roth instead, quietly, without disturbing any of those other numbers. Picture this scenario. You're 70 and you've had an unusually expensive year. Maybe a major home repair, maybe a big healthcare bill that wasn't covered by insurance. You need an extra $1,000 or $1,500 that month on top of your usual $9,500. If that comes from the IRA, it's taxable income on top of everything else you're already withdrawing. And depending on where you land, it could bump you into a higher bracket for the entire year. If it comes from the Roth, it's just money. No tax consequence, no ripple effect. That's the pressure relief valve. It's not there to be the main source of your $9,500. It's there so that when life throws something unexpected at you, and over 25 to 30 years it will, you have somewhere to go that doesn't create a domino effect across your entire tax picture. And this is why I love this account so much in a retirement income plan. It's not the biggest piece. It's not the one doing the heavy lifting month to month, but it's the one that gives you room to breathe when everything else is rigid. So now we've got all four pieces: Social Security, the IRA, the brokerage, and the Roth. Let's actually put them together and see how $9,500 a month comes out the other end. Let's walk through this with real numbers, because I think this is where it finally clicks. Our target is $9,500 a month, $114,000 a year. Let's say this couple has $1.6 million spread across the four accounts: $900,000 in a traditional IRA, $400,000 in a taxable brokerage account, and $300,000 in a Roth IRA. Combined Social Security is $3,800 a month. Step number one, the floor. Social Security covers $3,800 of the $9,500. That leaves $5,700 a month, $68,400 a year. That has to come from the portfolio. Step number two, the engine. The IRA, at roughly a 4.5% withdrawal rate, generates about $40,500 a year, or $3,375 a month before tax. After accounting for federal income tax on that withdrawal, let's say an effective rate around 12% once Social Security taxation is factored in, that's roughly $2,970 a month landing in the bank. That brings our running total to about $6,770 of the $9,500. Step number three, the gap filler. We still need roughly $2,730 a month, or about $32,800 a year. This is where the brokerage account and the Roth work together. And this is what I call the withdrawal order advantage. It's not just about how much you withdraw, it's about which account you withdraw from, in which year, based on what's happening with your taxes that year. In a normal year, the brokerage account fills most of that remaining gap. maybe $2,200 a month, using a mix of dividends already being generated and a small amount of share sales, taxed at capital gains rates rather than ordinary income. The Roth fills the final $530 or so, or sits untouched entirely in years when it's not needed, continuing to grow tax-free. In a year where the market has dropped, say 15 or 20%, the order shifts. The brokerage buffer covers a larger share of that $2,730. The IRA withdrawal might stay flat or even pause temporarily, and the Roth becomes the backup for anything left over. Nothing about the $9,500 changes from the household's perspective. What changes behind the scenes is which account is doing the work that month. And that's the whole point of this structure. $9,500 a month isn't coming from one place. It's being assembled every single month from 4 sources, each one chosen based on what's happening with the markets and your taxes that year, not on autopilot. This is what I mean by an income architecture instead of a balance. The money was always there. What was missing was the system that decides month by month where it comes from. But even a well-built structure like this one has things that can quietly undermine it over time. And that's what we need to talk about next. There are 3 things that can erode this plan slowly enough that you don't notice until it's already a problem. Let's go through each one. The first is the inflation erosion trap. $9,500 a month feels like a comfortable number today. But retirement isn't a single year. It's 25 or 30 years. At just 3% average inflation, that $9,500 needs to become roughly $12,800 in 10 years just to maintain the same purchasing power. In 20 years, it's closer to $17,200. If your income plan is fixed at $9,500 and never adjusts, you're not maintaining your lifestyle. You're slowly downgrading it, 1 year at a time, without ever making a single decision to do so. This is part of why the brokerage and Roth pieces matter so much. Social Security adjusts for inflation automatically. The portfolio withdrawals need to be allowed to grow with it too, or the floor becomes a larger and larger share of a shrinking real income. And the second threat is the healthcare escalation curve. Research from people like David Blanchett and Wade Pfau has shown something consistent. Healthcare spending in retirement doesn't stay flat, and it doesn't rise at the same gentle rate as everything else. It tends to stay relatively manageable in the early years, what researchers often call the go-go years, and then accelerates meaningfully later, especially once long-term care enters the picture. A plan built only around today's healthcare costs is quietly underbuilt for the years when it matters most. The third is the longevity multiplier. Every one of these risks, inflation, healthcare, sequence risk, the survivor shock we talked about earlier, gets bigger the longer you live. A plan that looks perfectly fine over 20 years can look genuinely fragile over 35. And with at least one spouse and a healthy 65-year-old couple having a real chance of living into their mid-90s, how long do I plan for isn't a minor assumption. It's one of the biggest levers in the entire structure. None of these threats are reasons to panic, and none of them mean the $9,500 framework doesn't work. What they mean is that the framework can't be static. It has to be revisited, not constantly, but intentionally, maybe once a year, so that the architecture keeps matching the life it's actually supporting. And that brings us to the real takeaway here. Because once this structure is in place, something changes that's bigger than the math. Here's what I actually care about. I want someone to look at their $9,500 landing in their account every month and know, not hope, know exactly where it came from, why it came from there, and what happens if next year looks different. This is the income confidence effect, and it's real. When retirees have a structure like this, a floor from Social Security, an engine from the IRA, a buffer from the brokerage account, and a relief valve in the Roth, their spending behavior actually changes. They stop hoarding money out of fear, or they take the trip, they help the grandkids. They spend the $9,500 the way it was meant to be spent because they trust the system that's producing it. That's the difference between having money and having an income. One sits there, creating anxiety every time you touch it. The other shows up month after month, doing exactly what it was built to do. So if there's one thing I want you to take from this video, it's this. Stop asking, how much do I have? And start asking, where does next month's paycheck come from and why? That single shift from balanced thinking to income architecture thinking is what turns a big number on a statement into an actual retirement. I post new videos every single day. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing.